Meantime, the all-important Fed decision just 2 days away. Our next guest wants the Fed to take a step back and end the rate hikes. Peter Boockvar is the Chief Investment Officer at Bleakley Financial Group. He's also a CNBC contributor. Peter, great to have you with us. And it's interesting how quickly people went from one side of the boat, 50, to the other side of the boat, which is either pause or 25. There is a case, though, to be made, in theory, that regulators have done so much to backstop the financial system, whether it be here in the United States or globally now, given the events over the weekend, that enables the Fed to keep, pounding at inflation and go ahead with the rate hikes.
I think that's what they're going to do. And it'll be 25. And while Powell's not going to use the word pause, he's going to basically imply a pause and that they'll take a step back and they'll see how things play out. I think from a risk management standpoint, they should be doing nothing. I mean, the world has changed. The world has changed a lot just over the past couple of weeks. And the Fed needs to really start thinking about how things unfold from here. So before the bank turmoil over the last couple of weeks, we've seen the tightest lending standards, not including COVID, in commercial industrial loans since 2009. The commercial industrial loan level in terms of amount outstanding up until the day before it totally unraveled with SVB, it was no higher than December. So the economy is already in motion to the downside. The Fed should at least acknowledge that. And they also have to keep in mind that just keeping rates at an elevated level for a while is its own form of continued monetary tightening.
Peter, it's Karen. I agree with you about what he should do, I think, is zero. But what do you think is the data, since he's data dependent, that he would need to see for, let's say, further lending tightening? Or what other metrics would you look at that they could say, all right, we're starting to see this is pressuring inflation as well, so we're heading in the right direction. We'll stay paused.
Well, unfortunately, a lot of the data he's going to look at is backward looking. We have to assume that at least small and medium-sized businesses are going to dramatically slow the extension of credit to their customers, both households and businesses. As they focus more on their balance sheet, they focus more on dealing with any bad marks that they have. They deal with potentially raising deposit rates to stem the outflow of deposits. And if you're a loan officer, you're now more interested in not making mistakes than potentially taking some risk and making new loans. So we have to assume where the economy is going to go from here, rather than them waiting for data that by the time they see it is going to be relatively old news.
Peter, can you help quantify this? I read this in the book report, your note this morning. You mentioned the C&I loans, so the commercial industrial loans, and specifically as it relates to commercial real estate. And so when you're talking about the exposure that a lot of these regional banks have to those sorts of lending, help us quantify what that means for the economy right here. Like you just mentioned some of these things. Does it really almost ensure that if standards are going to get that much tighter, that we will have a greater slowdown? So it's just amazing. We had Gerard Cassidy on before, and he's not in the hard landing camp. You know what I mean? Like, these guys are still in the soft landing, no landing camp. I just don't know how that happens.
So about 70% of commercial real estate lending comes from small and medium-sized banks. And you can only imagine what they're thinking now in terms of extending new loans that are coming due this year, or the keys that are being handed back to them by office owners that don't want to own the property. Well, you can be sure banks don't want the keys back either. They would love to see a borrower continuing to pay, because what is a bank going to do with this office building? So there's going to, and going into the last couple of weeks prior to this, banks were already sort of freezing their participation in commercial loans. And a lot of the commercial loans that were taking place were from non-bank lenders. And you can be sure the non-bank lenders at this point in the cycle are going to be charging double digits to commercial real estate borrowers in terms of interest rates.
So, Peter, we don't often get an outright, buy this or sell this from you. But would you say that there's more downside for regional banks at this point?
So I think the risk of potential dilution is certainly going to be important on the equity side. But a lot of these banks have gotten really beaten up that I do think that there's going to be some value to be had at some point. And even the biggest banks, we know that they're going to be a beneficiary of how this plays out. But I think sort of the super regionals, is where investors need to look at some point. But we know it's good to buy the banks when they're trading around book value. And now over the next coming quarters, there's a good chance that that book value starts to fall as banks remark a lot of their assets. But a good bank that's trading at book value or less is going to be attractive at some point over the next couple of quarters.
Peter, always great to get your take. Thanks. Peter Boockvar.
Thanks, Melissa.
Does it matter? I mean, if the Fed, of course it matters. If the Fed does 25 and then sort of says enough, or if the Fed does nothing and then keeps a hawkish tilt, does that nuance matter?
The nuance is all that matters. I think the Fed needs to keep people on their toes, and I think they're going to try to do that. I think they still have, their most important mandate that's left is certainly inflation. I look back to where we are. We're pricing in 75, 80 bips of price cuts on Fed fund futures. By the way, last week, Rick Santelli told us not to take that as gospels. He's absolutely right. They move all over the place, but that's where positioning is right now, and that's where that nuance is important.
Is a pause, Julie, going to cause panic? Is a pause going to say, oh my gosh, things are going awry and we don't have a good handle on it and we got to stop?
It's hard to say, right? That's how I would interpret it. I would interpret it as pretty negative, right? And they have access to some of the data that we don't as far as what's really under the hood at some of these banks. And the other thing that always concerns me is that recessions that are triggered by a financial crisis tend to be much deeper and harder to get out of, right? Because there's no lending that's really happening. And we can sit here and say, look, this isn't being triggered by, poor quality credit, but we have to think about 0% interest rates for more than a decade, and we think there's going to be no repercussions from that. We really think that all that credit quality is phenomenal. I don't know. I really worry about that longer term. And so, I think if they're at zero, to me, that signals, maybe there's more that we don't really understand that could be coming down the pipe.
100%. I think it's ludicrous to think that these major money center banks don't have similar mismatches as far as maturities. You say no.
I say no.
I will bet you, guaranteed. And let me, I'm just saying,
split screen.
Guaranteed. Think about since you've been in this business, okay, when there's free money to be had, or when people think that there's free money, or there's some sort of spread, there's some sort of trade, they all do it.
There we go.
They all do it. And all of these banks are going to be forced to be really transparent. You know why? Because all these major money center bank CEOs, they're on speed dial with the White House, they're on speed dial with the Treasurer, they're on speed dial with the FTC, and there's no hiding this sort of stuff.
Them being on speed dial with whoever doesn't mean they're taking duration risk. I don't know why you equate those two things they're irrelevant to me.
Okay, well, we'll see. I mean, I'm just saying I have no knowledge of it. And
I know. Look at the 10K. You'll have some knowledge.
I think there's duration risk.
I don't think there's duration anywhere remotely close to what you're saying. If you look at SVB's books, the 10-year plus duration risk there, some of which is mortgage-backed securities, which we know the duration gets longer, and Tim talked about that a week or two ago. It's nowhere remotely close to what J.P. Morgan's is. And if you look at J.P. Morgan's deposits and you look what's coming in, look at their 10K.
Okay, well, let's see what the marks.
We do know from the FDIC chairman that at the end of 2022, unrealized losses were $620 billion.
Yes.
I mean, is it fair to say it's $620 billion is not just Silicon Valley Bank and Signature Bank?
Correct. But what is the denominator of that, right? And rates have moved a little bit the other way since then. And if you if you marked the mark to market, the held to maturity, the change at J.P. Morgan would actually be the smallest, pretty small on an absolute basis, and way smaller than all of the other GSIB banks.
I would agree with the denominator part, except that it's not spread across banks. It is concentrated, and we've seen what just a couple of blowouts. But
what is the denominator of assets?
Okay.
I mean, it's at least 11 trillion if you're saying it's just GSIBs.
Right, but that didn't help.
But you're also saying no hedge. You're saying no hedge.
If they hedge,
that is not correct.
If they hedge, though, okay, it's my understanding. If they hedge those books, then they have to take those marks, okay. And so my point is, they might not have taken the marks just yet because they haven't had a run on their assets, Karen. So that's my point. And if anything, they've taken in a lot more assets. So Listen,
they've taken a lot more assets right now, which are just deposits and cash.
We could have been arguing the same way in mid-March of 2008 what kind of like was going on with Bear and some of the run that was on, and we could have been saying no, all these other peers were not doing some of the same stuff, did not have the same exposure.
Can I
that would have been a really bad. That would have been a really bad.
Are you really going to play?
Can I be Switzerland? Because Switzerland's been in the news, and they're there to protect their banking sector. So I'm here to protect you guys. I just think that there's 2 points that are being made. I'll echo your most important point of the day, which is that credit is still out there. Oh. Credit is lurking. Karen's point is very clear. Very different balance sheets, very different approach to their lending business, and not even close in terms of the risk. They're not in the business to take that kind of risk. So welcome to the Europe. Welcome to the European Union. Nice to yes.
It's funny that you say that because a bank like JP Morgan has made tremendous inroads in investment banking. How do they do that? Okay, how do they do that? They do that with a whole host of other products and services, the same business model that Silicon Valley Bank was in to win a lot of those same mandates and those same customers. So what I'm saying is we just don't know. Right? We don't know. And I don't know. It just doesn't seem that compelling to me right